Good evening. Welcome to Kenya News Update today. I'm your host, and tonight we're diving deep into a major economic development that could reshape Kenya's agricultural and technological landscape. Over the next 12 minutes, we'll unpack a massive investment announcement, analyze its potential impact, and debate the opportunities and challenges it presents. We're talking about a commitment of 206 shillings billion, that's USD 16 billion, from a Dubai-based firm, aimed at transforming farmland and building data centers across Africa, with Kenya as a key beneficiary. But is this a game-changing partnership or a complex promise with hidden strings? Let's get into it. First, let's establish the facts. The Maser Group, a company historically known for manufacturing consumer electronics like televisions, is making a dramatic pivot. Their new focus? Africa's twin challenges of food security and digital infrastructure. Through a public-private partnership model, they've committed to investing 206 shillings billion across three nations, Kenya, Ghana, and Nigeria, over the next 24 months. The breakdown, as reported, is significant. For Kenya, the investment is pegged at 38.71 shillings billion, or USD 300 million. Ghana is set to receive 64.51 shillings billion, that's USD 500 million. And Nigeria gets the lion's share at 103.39 shillings billion, equivalent to USD 800 million. This isn't just corporate expansion. It's a strategic bet on Africa's future needs. So, what exactly is Maser Group planning to do with this capital? The project has two core pillars. The first is the acquisition and development of farmland. The goal here is to boost agricultural output, improve food security, and potentially create export opportunities. The second pillar is the construction of data centers. This addresses the continent's growing demand for reliable, local data storage and processing power, which is critical for everything from government services to burgeoning tech startups. It's a dual-pronged approach aiming to nourish both the population and the digital economy. Now, let's put this 206 shillings billion figure into perspective. To visualize the scale, consider this. The total investment across the three countries amounts to a staggering USD 16 billion. When we break it down by country, the allocations tell a strategic story. Kenya's share of 38.71 shillings billion is a substantial injection into its economy. But how does this compare to other recent investments? Well, it dwarfs another significant, yet separate, development we're tracking. A Dutch-based animal nutrition giant, De Hughes, is opening a state-of-the-art $3 billion animal feed factory in Athi River this month. That's a 3 shillings billion investment, a serious commitment to Kenya's livestock sector. Yet, it is over 12 times smaller than the Maser Group's planned outlay for Kenya alone. This contrast highlights the transformative scale Maser is proposing. This brings us to our first major debate point, the opportunity. Proponents argue this is exactly the kind of large-scale, foreign direct investment Kenya needs. The PPP model means shared risk and theoretically aligned interests between the private company and the public. The farmland development could modernize agricultural practices, increase yields, and create thousands of jobs in rural areas. The data centers could position Kenya as a regional tech hub, reducing latency for local internet services and attracting more digital businesses. The timing seems perfect, aligning with the government's own agendas on food security and digital transformation under President William Ruto's administration. Furthermore, it signals confidence in Kenya's economic stability and growth potential from a major international player based in Dubai, a global investment powerhouse. However, there is a counter-narrative, a perspective of caution and scrutiny. Critics immediately raise questions about land. Large-scale acquisition of farmland by foreign entities has a fraught history in Africa. Who owns the land being targeted? What are the terms of the leases or purchases? Will local communities be displaced, or will they be integrated as partners and beneficiaries? There are concerns about neocolonialism, where foreign firms control vital resources, exporting profits while leaving minimal local value. The data center pillar, while less contentious regarding land, raises issues of data sovereignty. Where will Kenyan data be stored, and under whose jurisdiction? In an era where data is the new oil, ceding control of infrastructure could have long-term strategic implications. Let's delve deeper into the PPP structure. Public-private partnerships are not new to Kenya, with mixed results. The advantage is clear. The government may not have 38.71 shillings billion lying around to invest directly in high-tech farms and data centers, so leveraging private capital and expertise makes sense. The private company brings efficiency and technical know-how, but the risks are equally clear. These deals are often complex, with negotiations happening behind closed doors. Will the terms be favorable to the Kenyan public? What happens if the project fails or the company decides to pull out? Who bears the ultimate cost? The history of PPPs globally is littered with examples of cost overruns, renegotiations, and projects that ultimately burden the public purse more than if the government had acted alone. Now, consider the geopolitical angle. The investment originates from Dubai, a key financial center in the United Arab Emirates. The UAE has been aggressively expanding its economic and strategic footprint across East Africa, from ports in Somaliland to logistics deals in Ethiopia. This investment fits a broader pattern of Gulf state engagement with Africa, often blending business, diplomacy, and strategic resource security. For Kenya, navigating this relationship is delicate. The investment is welcome, but it must be managed to ensure it serves Kenya's national interests first and foremost, not just those of an external power. This is where strong, transparent governance from the Kenyan side becomes non-negotiable. Shifting focus slightly, let's talk about the animal feed factory as a point of comparison. The Ksh 3 shillings billion facility in Athi River, opening on February 18th, represents a different model. It's a focused, sector-specific investment by a company with a century of experience in animal nutrition. Its impact will be direct, improving the quality and availability of feed for Kenya's poultry, dairy, and aquaculture industries, potentially lowering costs for farmers and improving food security from the bottom up. It's less flashy than a 206 shillings billion continent-wide announcement, but it may be more immediately tangible and easier to manage. The debate here is about quality versus quantity of investment. Is a dozen targeted, expert-driven 3 shillings billion projects sometimes better than one mega deal? Both are needed, but they require different regulatory and oversight approaches. Returning to Mazer, we must ask, why the pivot from TVs to farms and servers? The consumer electronics market is notoriously competitive with thin margins. Africa's agricultural and digital infrastructure gaps represent a long-term growth play. Mazer is essentially betting that the future value of food and data in Africa will outstrip the value of selling televisions. It's a fundamental repositioning of the company. For Kenya, the question is whether we are partnering with a visionary pioneer or a company venturing far outside its core competency. Do they have the agricultural science and data center operational expertise to deliver, or will this be a costly learning experiment on Kenyan soil? Due diligence on Mazer's capability, beyond its financial muscle, is crucial. Let's talk about the human impact, the potential job creation. Large-scale, mechanized farming can be a double-edged sword for employment. It may create some high-skilled jobs for agronomists and engineers, but it could displace many more low-skilled subsistence farmers if not integrated carefully. The data centers will create technical jobs in construction and IT maintenance, but these require specific skill sets. A critical part of any deal must be a concrete, enforceable plan for local hiring, training, and skills transfer. The investment shouldn't just be about capital flowing in, it must be about human capital building up within Kenya. Without this, the long-term benefits will be limited. We also cannot ignore the global context. The world is grappling with climate change, and agriculture is both a victim and a contributor. Will Mazer's farming initiatives be sustainable? Will they use water-efficient technologies, protect biodiversity, and enhance soil health? Or will they be water-intensive, monoculture operations that degrade the land? Kenya's water resources are already under stress. Similarly, data centers are enormous consumers of electricity. Will they be powered by Kenya's growing renewable energy grid, or will they increase reliance on fossil fuels? The environmental clauses in any PPP agreement are not just nice-to-haves. They are essential for the project's long-term viability and social license to operate. As we approach the final minutes of our deep dive, let's consider the alternative. What if this deal doesn't happen, or what if it fails? Kenya would miss out on a massive capital injection and the potential modernization boost, but it might also avoid the potential pitfalls of land alienation and a problematic partnership. The government's task is to negotiate a deal that maximizes the upside while ring-fencing the downsides. This requires unprecedented transparency. The full text of the PPP agreement, once finalized, should be made public for scrutiny by Parliament, civil society, and the media. The terms on land use, profit sharing, tax holidays, dispute resolution, and exit clauses must be clear and fair. In conclusion, the announcement of a 206 shillings billion investment from Dubai's Mazer Group is undeniably significant news. It places Kenya at the heart of a continental strategy linking food and technology. The potential benefits for economic growth, job creation, and infrastructure development are substantial. However, this is not a moment for uncritical celebration. It is a moment for rigorous, clear-eyed analysis and tough negotiation. Kenya must enter this partnership from a position of strength, with its interests clearly defined and protected. The DeHughes Feed Factory reminds us that steady, specialized investments also have tremendous value. The future of Kenya's economy will likely be built on a mix of both transformative megaprojects and consistent sectoral growth. The key for the administration of President William Ruto will be to manage this complex investment landscape with wisdom, transparency, and an unwavering focus on Kenyan prosperity. The world is watching. Subscribe to Kenya News Update today for continuing coverage on this and every story shaping our nation.